Hello and welcome to Moneylife News and Views. I'm Debashis Basu. The Indian equity markets present a striking paradox. Mega companies are struggling with their businesses as if India is in a recession, and yet their stock prices remain firm, except now, of course, the IT companies which are crashing thanks to the rise of AI. Scores of small firms are doing extremely well, as if India is growing at 10% or more, and yet the stock prices are languishing. How will this paradox get resolved? In my view, we may see an outperformance by quality small companies and possibly continued stagnation in the large cap stocks. The Indian equity markets have underperformed most global markets since the market peaked in September 2024. It was an 18-month bull run, and since then, it has been a gross underperformance. During that bull run, the bulls refused to be reined in even by the underwhelming performance of the ruling party in June 2024 general elections. After a day of shock at the results, the markets resumed their upward march until economic headwinds started emerging later in 2024, followed by an 18-month phase of poor performance. However, if you look at the large companies in Nifty or CNX 500, this underperformance may not be obvious. While Nifty was down by 2% between early 2024 and late January 2026, the CNX was down by 5%. But over the same period, the Nifty Microcap index was down 17%, and the median returns of these stocks were far worse. Some of the declines in the smaller stocks was justified. Many of them had become too expensive, carrying very high growth expectations, aided by strong fund flows. So when the economic headwinds started blowing in 2025, expensive growth stocks were sold off. These headwinds came from three sources. First, reduced government Capex, the principal driver of the 2023-24 bull market, which was initially blamed on 2024 elections, but the reduced Capex continued well into the following year. Second, India was hit with punitive tariffs by the US in 2025. Third, there was a slowdown in domestic consumption due to high taxes and slow wage growth. Spooked by this barrage of negative news and very average performance of Indian stocks, Indian companies, foreign institutional investors sold heavily. Net outflow was nearly $23 billion across 2025 and January 2026 combined. The problem during such phases of selling is that investors tend to be indiscriminate. Good stocks get punished along with the bad ones. Coinciding with continuous FII selling, the Reserve Bank allowed the rupee to weaken, possibly to support exporters, which were hit by Trump tariffs. Now, since Indian equity markets have been highly correlated with the value of rupee, this made matters worse. And as rupee fell, the foreign investors sold more and the rupee remained weaker. Last year turned out to be one of the worst performance for Indian markets in over 3 decades. It underperformed other emerging markets by nearly 40% in dollar terms. In such situation, buyer's strike sets in, making markets brittle. So the market can fall very sharply for no clear reason, as we saw last Thursday when the Sensex dropped by about 1,400 points. Is there a silver lining to any of this? There is. The December quarter has given us data that is suddenly very positive. Continuing with the paradoxical price behavior of large cap stocks, which are resilient, and small cap stocks, which are wilting, we have just witnessed another weak quarter for Nifty 50 stocks and an excellent quarter for Nifty Smallcap and Microcap stocks. Now, to give you some numbers, sales of Nifty 50 companies, which include the mega cap firms, which is the Reliance and the Larsen Toubro and the Hindustan Lever and so on, were up 10%. But they recorded 0% operating profit growth and only 1% net profit growth. The picture was slightly better with the broader CNX 500 companies, which recorded an 11% increase in sales and 8% growth each in operating profit and net profit. And it was similar in BSE 250 large and mid-cap stocks. Contrary to conventional wisdom, what is that conventional wisdom? It assumes that smaller companies do worse under economic stress because they have less resources than larger companies to withstand headwinds. Contrary to this wisdom, smaller companies have done very well. Sales growth of Nifty Microcap index was 12%, operating profit growth was 13%, and net profit growth was 24%. The best performing group was the Nifty Smallcap 250, which recorded sales of 11%, operating profit growth of 22%, and a stunning net profit growth of 38%, thanks to triple-digit profit growth in many companies such as Mangalore Refinery, Chennai Petroleum, Craftsman Automation, Force Motors, MCX, Ramco Cement, Engineers India, Laurus Labs, and so on and so on. I do not know whether this will lead to a new bull market, especially in small cap stocks, but we are probably in a situation quite opposite to the one we were in September 2024. Valuations are now very reasonable for many small but fast growing companies. The fundamentals have improved, as mentioned above. Of the 1,000 companies that we track, about 200 of them have reported operating profit growth of 30%, which is the highest number since the June quarter of 2023. There are also a few economic indicators that support this view. Government capital expenditure has gone up. There is some pickup in private sector investments as well, if you go by corporate data. The commercial vehicle segment is doing very well. E-way bills have hit new highs, and bank credit growth remains strong. Improving fundamentals of quality small caps combined with falling stock prices make for a very interesting combination. And do share and subscribe to the channel. Thanks for watching.